Welcome back to the desk, everyone. Let us dive straight into the numbers for Friday, July 17th. The market gave us a very clear signal during the last session, and the tech-heavy indices are starting to feel some real pressure. But first, let us look at our absolute gold standard here, keeping things completely transparent. On our last daily briefing, we forecast a sideways close for the indices. That call was incorrect. The S&P 500 closed down 0.5%, and the Nasdaq dropped 1.5%, completely breaking our 0.2% flat boundary. We do not hide our losses here. We learn from them so we can make the next setup sharper. Looking at slide 2, we can see a major split across the main boards. The headlines are focusing on the red, and for good reason. The Nasdaq Composite took a sharp pullback, dropping 1.5% to close at 25,881.90. The S&P 500 also rolled over, losing 0.5% to finish at 7,533.8. The Dow lost 0.2%, closing at 52,553, while the small-cap Russell 2000 managed to hold its ground, ending basically flat with just a 0.1% dip. But this is not a market-wide decline. It is a massive structural rotation. Check out slide 3, because this is where the real story lives. Underneath that weak index performance, market breadth was almost a perfect 50-50 split. We had 47.1% of stocks advancing and 49.3% declining. On top of that, 52.7% of names are still trading above their 50-day moving average, and 52% are holding above their 200-day line. This proves that while the main indexes look like they are pulling back sharply, the broader market is actually holding its own. The money is not fleeing the stock market entirely, it is just moving house. Slide 4 shows you exactly where the cash is running away from. Tech and semiconductors faced heavy selling pressure. Broadcom dropped 5%, AMD fell 5.3%, and Micron dropped 5.7%. Intel took a 5.8% hit, and even Nvidia could not hold up, losing 2.4%. Google also faced heavy pressure, dropping 4.4%, while Meta fell 2.5%. This is aggressive, institutional-level distribution in overextended tech sectors. But look at where that cash found a home on slide 5. Capital did not leave the system. It rotated straight into defensive growth and traditional value. Microsoft managed to print a 1.4% gain, while Apple climbed 1.8%. Healthcare names acted like massive safety cushions, with ABBV surging 4.2% and Eli Lilly up 1.1%. We also saw big credit service names like Visa up 2.8% and MasterCard up 3.1%. This is a textbook flight to safety and defensive yield. Now let us look at the technical damage on the charts. Slide 6 shows the Nasdaq 100 hourly view. This was a sharp breakdown. Sellers easily pushed past our local support lines and pushed the price down to 29,030.4. There was absolutely no buying volume on the way down, which tells us institutional players are aggressively clearing their books and de-risking ahead of the weekend. Slide 7 shows the S&P 500 hourly chart, and it gives us the exact same warning. Look at that clean, textbook double top rejection, right near 7,580 points. Buyers tried to push the index higher twice, got completely swamped by institutional supply, and triggered a sharp downward extension straight down to 7,533.8. We are now sitting right on the edge of the major 7,500 support floor. Turning to slide 8, we have got some heavy macroeconomic event risk to manage today. First up, President Trump is scheduled to speak this morning, and you could expect that to trigger some sudden, algorithmic volatility. Later tonight, we get the preliminary University of Michigan consumer sentiment data, which is forecasted to come in at 51, up from the previous 49.5. We will also get the latest inflation expectations, which sat at 4.6% last time. Keep your risk tight when these numbers drop. On slide 9, here is our tactical game plan. For the S&P 500, the big battlefield is that 7,533 floor. If that breaks, pressure could accelerate quickly down towards 7,500. On the Nasdaq, we want to watch if 29,030 can hold as support. Our main stance here is patience. Do not try to step in front of a falling market in semiconductors today. Let the market settle, watch the consumer sentiment data, and trade within these clear boundaries. To wrap things up on slide 10, the big takeaway is that we are witnessing an orderly but aggressive rotation. The index charts are technically vulnerable, but the broader market is just shifting into value and defensive plays. Because of this and the lack of buyers on the hourly pullbacks, our official predictive technical call for the next session's close is down. Remember, we are looking strictly at the final closing print and ignoring intraday noise. This daily session briefing utilizes AI-assisted quantitative tools and is strictly for educational and informational purposes. This is not professional financial advice, and you should always manage your own risk and position size with extreme discipline. Have a great trading session, stay safe, and I will see you all next week.